Hi, it's Nero here from Investment Rise, and today I want to talk about how banks are changing their tune when it comes to the Australian property market. Now, you might recall back when the coronavirus pandemic first really started affecting Australia and we had all these lockdowns across the country, banks were sort of coming out and making all sorts of scary predictions about the property market. I think Westpac and NAB came out and said they expect property prices to drop by 20%, but then CBA decided to take it up a notch and they came out with this scary headline and saying that property prices were going to drop by 30%. Now, at the time, I put out a video really questioning that and debating that because I thought that prediction was horribly wrong. Well, soon afterwards, CBA then came out and said, no, we don't expect it to be a 30% drop. We now only expect a 10% drop in property prices across the country. But they've since revised that even further. So they've gone from 30% drop in property prices, which scared a lot of people, then to 10% price drop, to now they're saying that they only expect a 6% price drop across the country. Now, that means that if you take a standard property for, say, $1 million, like it might be in Sydney, and if it drops by 6%, that means it goes from $1 million down to $940,000, right? So a 6% price drop, does that sound like a market that's crashing right now? But here's the good news, is that CBA have actually then gone through and broken up that average prediction across the country. They've broken it up by city. So let's go through some of that data right now. Now, obviously, it's Melbourne that they are expecting to have the biggest price falls, and they've said that they expect a price drop to be 10.2%. Fair enough. Although I personally think that might be a little overstated, I do agree with the fact that I think the Melbourne market will suffer the biggest price falls across the country, only because unfortunately the coronavirus situation seems to have impacted them worse than anybody else. But then we come to Sydney. They expect prices to drop on average 4.9%. Brisbane, 2.5%. And then across other cities is even less than that, and they think that Canberra will be the only market where prices will rise. Now, I do agree, mind you, that I think the Canberra market, especially the house market there, has got good potential for capital growth. But let's come back to look at some of these figures here that they're talking about. A 4.9% drop in property prices. So say 5% in Sydney. Now, do you think that's a huge drop? Right? I mean, you could literally, if you're looking to maybe sell your home today, you could go and get 3 real estate agents to come in and appraise the property and give you what they think they could sell the property for. And there could easily be more than a 5% difference between the highest appraisal value and the lowest appraisal value. Okay? So a 5% drop isn't a great deal. But mind you, here's the big takeaway. They expect these drops to only be from September 2020 to June 2021. And then after June 2021, so in the second half of next year, they expect prices to start rising. And in both Brisbane and Sydney, they expect the prices at the end of 2021 to be higher than they are right now. So what does that mean for you as an investor? Well, if you're able, so if you feel secure in your job and you've got the borrowing capacity and the surplus cash flow each month, and if you're willing to do your research, and I'll talk more about that a bit later on in this video, now might be the opportunity for you to go ahead and get a great deal. Because if CBA is right, in a year's time from today, prices will be rising and prices will be higher at the end of next year than they are right now. And remember, property investing is a long-term game. If you're someone who's trying to speculate in property and pick the absolute bottom of the market and then try to pick the top of the market, I think you're going to really struggle as an investor because none of us have a functional, working crystal ball. Right? On the other hand, if you're trying to speculate in property by buying, renovating and selling, it's a higher risk strategy. And yeah, you might want to wait until you see some more evidence of the market rising in value. But if you're someone who's looking for good, steady growth over the next 5 to 10 years and you're planning for the longer term, it's clearly showing, mind you, that the data is showing that there are some great opportunities right now. You see, a price drop of 4.9% on average, mind you, isn't that big when you consider that the biggest price fall that we had in history in Sydney was between 2017 to early to mid 2019, when prices on average fell 11%. Yet I don't remember anyone telling me in early 2019 that the property prices in Sydney were crashing and that property prices were cheap. Right? And then, mind you, according to CoreLogic, prices in Sydney in 2019 rose by 5.3%. Right? And they were on track to hit all-time record highs before COVID-19 appeared. So the market fundamentals were very, very strong. However, that doesn't mean you can just go and buy anything. There are some properties and some areas you need to avoid. And if you've seen any of my past work, and you'll know what I'm about to say. And that is, you need to stay clear of off-the-plan units. All right. Now, especially there are some areas that you definitely want to have on your no-go list, and they are Rouse Hill or the northwest of Sydney, Gosford in the Central Coast, Docklands in Melbourne, Surfers Paradise in Queensland, Parramatta in Western Sydney. Why these areas in particular? I mean, I'm not saying they're the only areas to avoid, but these are definitely ones you want to cross off and not go to when you're looking at off-the-plan units. And the reason is because these areas will be heavily oversupplied in the next couple of years. Rouse Hill, for example, is going to see the number of units available triple in the next 2 years. And they've already got a problem with record high vacancy rates today before the number of units triple in supply. That's and the number of units tripling in the next couple of years. Gosford on the Central Coast, well, that will see an increase of over 72.9% in supply. And again, Gosford is a market right now that's already slightly oversupplied. Parramatta will see an increase of 13%, but it's a market that's already oversupplied, and the supply is going to increase at a rate faster than demand. Now, you want to really avoid these areas where all this supply is coming on board, because we've seen it before and I expect we'll see it again. You're going to see banks value these off-the-plan units when they are completed, when it comes time for you to settle. They're going to value these units almost certainly at less than what you paid for them, which is what they did back in 2017 and 2018, which caused a lot of investors some serious financial and emotional heartache. For example, if you buy an off-the-plan unit for, say, $820,000, but when it comes time to settle, which means the unit is now completed and you now need to take ownership of it, if the bank values that unit that you paid $820,000 for, if they value it for just $760,000, that's a $60,000 difference. And guess who's got to front up that $60,000? Guess who's got to find that $60,000 out of their back pocket? You do. And if you can't, you've got to walk away from the property, but you lose the deposit that you've already paid. As I said, we saw this time and time again in 2017, 2018, even 2019. For example, I think it was in late 2018, I spoke to a lady who had bought an off-the-plan unit near the airport in Sydney, and she'd paid $1.23 million. So she'd put her 10% deposit, which is $123,000. Yet, when it came time to settle, when the unit was complete, her bank valued the property at under $1 million. Now remember, she paid $1.23 million. The bank valued at under $1 million. So that's over $230,000 difference. So she had to come up with an extra $230,000 if you want to go through with that property. She didn't have that kind of money, so she had to walk away. But she also had to walk away from her 10% deposit, which was $123,000. Imagine putting up $123,000 of your hard-earned money or your equity from your home or an existing investment property, and then it just going up in smoke and you get absolutely nothing for it. Well, that's exactly what this poor lady had to experience. I expect that you're going to see that again for many investors who buy off-the-plan units, especially in these oversupplied areas. Also, another type of investment that you want to avoid are those inner city unit blocks, especially those large towers. They may already be built and available, but we're seeing prices drop quite dramatically in those apartment blocks in many of the inner city areas, and people are really struggling to get them rented, and banks are even looking to stay away. In fact, I think what you'll see now is that banks will start to be more selective in the areas and the types of properties that they want to lend on. Because remember, over the last several months, banks have offered all sorts of mortgage holidays, and as a result, that's impacted their bottom line. So now they obviously want to look to increase profits, but they don't want to increase risk at the same time. So what are they going to do? I expect they'll do what they have done before, which is that they will focus more on, as I said, certain areas, certain types of dwellings. And I think in particular, you're going to see them focus more on customers who want to refinance. In fact, banks right now are giving cash incentives for many people to refinance, number one. And they'll also look to buyers who are buying houses as opposed to apartments. And we saw this back in 2015, 2016, when it was Macquarie Bank who first came out with a report saying these were suburbs that they thought were very risky. Now, what were these suburbs? Well, they include suburbs like Chatswood in Sydney, Docklands in Melbourne, and the Brisbane CBD. Interestingly, these are all suburbs that have a very high concentration of units. I think you'll see the same thing again. So suburb selection is going to be very important. Asset selection, or the type of dwelling or property you're looking to buy, is going to be very, very important. But one of the messages I really hope you take away is that our property market is once again proving to be robust, like it was during the last recession we had to have back in the 90s, when property prices dropped 4.9 or rather 4.4% across the board on average, during the GFC when they dropped about 7.9% across the board. And mind you, both these drops were followed by very fast upturns, and I think you're going to see the same thing again. So yes, banks are certainly changing their tune when it comes to property in Australia. They're not expecting the market to crash. So if you're someone who is holding out, waiting for a bargain, probably now is as good a time as ever, certainly over the coming few months. But they also expect that if there is any downturn, it's going to be very short-lived. It's going to be very, very mild, and they're expecting the market to regain steam in 2021. But mind you, I expect that you will see that there are certain suburbs who, yes, will suffer more, like what I mentioned earlier on about the suburbs that are oversupplied. But there are some suburbs that will almost have zero downturn. They're going to hold their value, and they're the ones that are going to rise the fastest. So as an investor right now, there is certainly more risk, but also more opportunity. More risk if you think you can invest without doing your research, think you can just buy something in an area that you know that's maybe risen before. I think there are certainly a lot of risks associated with that. But on the flip side, I think there is a lot of opportunity for the smarter, more strategic investor, the investor who gets some professional help, who does their research, and who buys well. I think there's some great opportunities right now. But if you stick to the house market, if you look at suburbs with a very tight vacancy factor, because that's the other thing you really want to look at, there are many areas in Sydney and Melbourne where rents are falling very, very quickly. In fact, rents are falling far more as a percentage than property prices are in many of these areas. So check what the rentability is like, check the vacancy factor, and I think if you can do your research correctly, the next few years could be the start of a great journey for you as a property investor, and you might look back at 2020 and 2021 as being the time when you really kickstarted your property investing portfolio. Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.